Welcome back to Carolina Journal Radio. I'm Donna Martinez. Taxes are the talk of politics at all levels of government. Last month here in North Carolina, voters in Charlotte-Mecklenburg voted down a proposed hike in the sales tax. State lawmakers have looked at the franchise tax imposed on businesses, and at least one presidential candidate is rolling out a plan to tax wealth, not just income. Joe Coletti is senior fellow with the Locke Foundation. He's our expert on all fiscal and tax issues, and he's been taking a look at all of this and is here to talk about it. Joe, welcome back to the show.
Glad to be here.
Let's start with the federal level here. So taxing the rich seems to be an idea that is getting a lot of traction in this country. What do you make of it?
The question of inequality and mobility is the starting point for that. That we take a look around the economy over the past few years and how do we help people at the lower end be able to advance? And unfortunately, sometimes when people look at that, they think that the best way to help somebody at the lower end of the economic spectrum is to penalize people at the upper end of the spectrum. And that's where this starts, is the wrong prescription for potentially the right diagnosis. That if we're an unequal society, then there are problems, but the way that you do it is either by lifting the bottom or cutting down the top, and that's where this all starts. Is some jealousy and some envy and some general distrust of how people got their money.
We hear the phrase "fair share" a lot as well, and the implication there and the belief behind that is that people at the higher ends of the income spectrum are being taxed at a lower rate than people at the low end. What about that?
There's actually the New York Times recently had an op-ed by one of their reporters based on a new book by Emmanuel Saez, who's been writing on inequality for a long time and is an advisor to Elizabeth Warren and has advised Bernie Sanders as well. So this should all sound like this is coming together in a way. And they've taken a look at what the tax burden on wealthy people versus the rest of us is, and surprisingly, Matthew Iglesias, who is left of center, writing at Vox.com, took a look at what they did and said, they put a lot of assumptions into this to be able to get to their conclusions about how the rich pay less in taxes than the rest of us do, and pointed to some other earlier work by Saez with Thomas Piketty and some work from folks in the federal government at the Congressional Budget Office that show potentially much higher, much more progressive taxes in the country than what the current research is showing. So it all depends on assumptions. It's likely that the rich, because of tax rates, do pay more, and the federal tax code is more progressive than most people give it credit for.
If someone is wealthy and they've been working all their lives, maybe it's through a business or maybe someone even inherited wealth, is there anything inherently wrong with the fact that they have more than many people do?
No, actually, the best description I've heard of what's wrong with the wealth tax came from a professor at the University of Michigan who said, Daniel Radcliffe, who played Harry Potter in all of those movies, saved his money and has put it aside so that he can work on the movies that he wants to work on, art or whatever else. Johnny Depp has been in countless movies and has gone bankrupt because he couldn't figure out how to use all of that money that he has. And she concluded with, I don't know that I want a system that penalizes Daniel Radcliffe and rewards Johnny Depp. I think that's, if you can get down to that level, most of us are like, the wealth tax doesn't make sense. Yeah.
Joe, I like the fact that you write and talk a lot about this issue of helping people, particularly those who are vulnerable, maybe living on the margins, really living paycheck to paycheck. And as someone who grew up poor, I can really relate to that. I remember those times growing up when literally we didn't have any money, and we were one of those families, even though it was a working family. We were the working poor. With my mom and dad, I now know as an adult, were wondering where was dinner going to come from. So here in North Carolina, there's been an effort with the tax code by state lawmakers to really address that. One way they've done it is with what's called the zero tax bracket or the standard deduction. Help us understand what North Carolina lawmakers have done and how that helps particularly those who are living paycheck to paycheck.
Yeah, the tax code starting in 2013, the General Assembly moved it to a flat tax rate, but expanded the standard deduction, as you mentioned, which is the amount of money that you can earn before you start paying a dollar in taxes. And so right now we have a 5% income tax rate, and the standard deduction, as signed into law by Governor Cooper, will be increasing by another 7.5% in the next year, and that's going to save people money in that. And because it's the first dollar that you earn up to the 20,000th dollar that you earn if you're married filing jointly, that means that $20,000 of your income is tax-free. And so that does allow you to be able to spend more and take care of those basic needs, because that first $20,000 is your basic needs. It's probably a little bit more than $20,000, but it covers that. That gets you ahead of the curve. And then that first dollar that you earn, that $20,000 and first dollar, is the effective tax rate on that is relatively small, because it's taking into account all the rest of that. And it makes the tax code, it does make the tax code progressive, which is what folks on the left want, while making sure that the people at the bottom end are the most protected.
Joe, I want to make sure that we talk about something that you also have been writing about related to this, the whole issue of taxes, and that is people who want to use punitive taxes to get people to not buy certain products. We've seen that with cigarettes. Soda is now kind of in the crosshairs of a lot of people, and several different cities have imposed what's known as the soda tax. We're starting to get some information on whether or not that actually is effective. What have we learned?
For the most part, it is not. In Philadelphia, for some reason, higher taxes have cut down on soda consumption, but most of what these soda taxes have done is raise the prices in cities where they are imposed, and because folks who have less transportation, folks at the lower end of the income scale, can't go out to have less access to places outside of the tax district where they can purchase sodas. Whereas somebody with more money is able to go to Costco, buy cases of it, right, and avoid that excess tax that's there. And it leads to a lot of weird things because of what gets taxed and what doesn't get taxed. Right?
And apparently there are even people who say, well, we can actually go one step further and, quote, solve that problem you just described by having a nationwide tax on soda.
Yeah, that's if you can't get people to do what you want in a specific place, then just impose the penalty across everybody. So
there you go. Well, folks, you can read all about these tax issues in Joe Coletti's work for the John Locke Foundation. You'll find that at johnlocke.org. Joe, thanks very much. It's been fun. Appreciate you joining us. That's all the time we have for the program this week. Thank you for listening. On behalf of my co-host, Mitch Kokai, I'm Donna Martinez. Hope you'll join us again next week for more Carolina Journal Radio.